Halo, selamat malam rekan-rekan sekalian. Malam hari ini kita akan mengikuti webinar mengenai Identifying Fraud and Financial Manipulation yang diselenggarakan atas kerjasama CFA Society Indonesia dan juga Kroll. Untuk webinar malam hari ini akan dilaksanakan dalam bahasa Inggris. Jadi apabila rekan-rekan sekalian ada pertanyaan yang ingin ditanyakan dalam bahasa Indonesia, silakan diketik dalam chat box dan saya akan mencoba membantu mentranslasikan pertanyaan rekan-rekan sekalian. So with that being said, I'm gonna introduce myself as the moderator tonight. My name is Adwin Suryana, and my background is I spent 6 years in an accounting firm in San Francisco Bay Area and 2 years in evaluation and business modeling of a Big Four accounting firm. I'm a CFA and FRM charter holder and also an MBA from University of San Francisco. Here are some of the webinar rules. Please write your name as you registered, and all of the participants will be muted. So if you have any question, feel free to type it in the chat box. And we'll try to ask the questions to the lecturer during the session. Usually it's going to be done during the break of each section. So if you like to ask questions, please write them in the chat section at any moment, and I will address them sequentially. There will be an opening speech by Mark Rooney. Mark is the Chief Financial Officer for CoinWorks, and he is also the CFA Society Indonesia board rep. And our speaker for tonight, first one is Ben Crilly. Ben is the head of Indonesia for Kroll. Ben is based in Jakarta office, and he has over 16 years of experience specializing in the field of restructuring and turnaround in Indonesia, Singapore, Malaysia, DRC, and Australia. Ben is a chartered accountant and has a Bachelor of Commerce from the University of the Western Australia. And then the second speaker will be Pak Wilman Rumi. Pak Wilman is the director, also from Kroll, based in Jakarta office. Pak Wilman is experienced in managing the insolvency and PKPU process in Indonesia. Pak Wilman has a Bachelor of Commerce from the University of Guelph and holds CFP degree. And our third speaker is Pak Bambang Mulyawijaya. Pak Bambang is a senior manager based in Kroll's Jakarta office. His experience covers financial restructuring, corporate finance, share acquisition, share divestment, and valuation engagement. Prior to joining Kroll, formerly known as Borelli Walsh, Pak Bambang spent 4.5 years in the valuation and business modeling division of a Big Four accounting firm. Pak Bambang is also a CFA charter holder. For your information, tonight's webinar qualifies for 1.5 PL credit for all of the CFA charter holder, and the notification will be emailed to you by the CFA Institute. And with that being said, I'm going to hand it over to Mark for the opening speech. Go ahead, Mark. The stage is yours.
Yes, thank you, Pak Adwin. And look, I'd just like to firstly, on behalf of the CFA Society Board here in Indonesia, just really, thank everyone for turning up and supporting these events. I know since we've had Pak Rahmat take over the board, several months ago, we've put on a number of these events now, and they're very, very well received. Please also, keep your comments and keep your feedback coming in. The board, we're really trying to work hard to make sure that we're giving you things that are interesting and relevant. And these aren't just about earning CE credits. These are about keeping people engaged and keeping people active, especially during this time where most of us are sitting, at home in front of a screen somewhere for our daily lives. Thanks to the guys from Kroll here tonight to talk to us. Listening to the CVs, I'm sure there's a lot of interesting transactions, and I'm sure there's thousands of anecdotes behind in some of those things that's been happening here. So really looking forward to it. And tonight's theme is around identifying fraud and financial manipulation. And this is something that goes back to the dawn of finance, is that, since people were, trading gold nuggets for, bushels of corn back in the ancient Mesopotamia, there's always been this penchant for fraud and financial manipulation in finance, especially. And when it comes to money, there's always somebody trying to do the wrong thing, unfortunately, which is, part of the reason why with CFA society, we have these strong code of ethics and moral values. But we've just want to say, thanks everyone for turning up and supporting it. We're now in the digital age. There's a lot of interesting transactions behind it, where in my day job with CoinWorks, it's something that we're constantly being barraged with. It's something that our risk team and our technology teams are constantly dealing with, and this is a reality of business here in the 21st century. So without further ado, I'll pass it back to Adwin. But just quickly before I go, I'd just like to give a short plug for the Asia Pacific Research Exchange for CFA. So if you go to arx.cfa, and if you're looking for any sort of topic research or any sort of knowledge around any sort of topic that's Asia Pacific based, then we've already built up, over 15,000 articles in that database there. So please feel free to give that a click, and I won't take up any more of your time. But thanks everyone for coming.
Thanks, Mark, for the opening speech. So without further ado, we're gonna start the webinar for tonight. And our first speaker will be Pak Wilman.
Thank you, Padwin, and thank you, Mark, for the opening remark. And again, I just want to say thank you for your guys inviting us. It's a good opportunity and a privilege for us to be discussing with you tonight and sharing with you some of our experience. And I just want to double check. Let me share screen with you the presentation that I'm about to share. Give me one sec. Can you guys see my screen now?
Can do, Wilman. Just put it on.
I'll just zoom it. Yeah.
Slideshow.
Okay. Are you seeing the full slideshow now?
With notes.
Yeah. With notes.
Need to take the notes off. Where you have notes clicked, just unclick the notes.
Do I have the notes? Bambang, maybe you want to share? Okay. Okay. All right. We'll just go straight to the next slide, Bambang. You want to show slideshow? Can you do full screen, Bang?
It's already full screen on my screen here. Can you see the screen?
Maybe William can stop share first so that Bang can share. because we are not showing full screen. So if William can stop share, Wilman, then Bang, go ahead.
Okay.
Go ahead to screen share screen. Yeah, okay.
Right.
Yeah, good. Go ahead.
Okay.
William.
Okay. Thank you. And apology for the hiccup. Okay, I think maybe go back to the previous slide, Bang. We'll just quickly go through it. Today's session will try to make it brief and more engaging as you guys. I think the more engaging and the more questions you guys have, the better. So feel free to stop us at any point during the presentation and feel free to raise any comment or remarks as you see fit. So today we'll just share with you our key finding and then maybe explain to you the case study that we have seen on how we've seen financial misstatement and fraud are typically perpetrated. This is a real restructuring case that we've done recently, so it's still fresh in our mind. So yeah, hopefully you guys find it interesting enough and then you can have a lot of questions. Next slide, Bang. I won't bore you too much on the background, but just worth mentioning that in Indonesia, you guys probably have heard of us or know us as Borelli Walsh. We were recently acquired by Kroll, and late in 2020, we were actually acquired by Kroll, and then Kroll himself are actually one of the leader and leading investigation and dispute provider globally. And we have one of the largest valuation business in the world. And we're actually placed over in 30 countries, different countries. A lot of the job that we've done in Indonesia revolves around restructuring mainly, and but we've also done a lot of advisory on the due diligence and forensic work. Next slide, Bang. Okay, just to give you a highlight here, again, as mentioned previously, Borelli Walsh, we've done a lot of work in the restructuring advisory, and we sit in under the governance and risk division. Because the nature of our work tend to be under restructuring, we see a lot of the integration and also cross collaboration on the other side of the work, such as the investigative work. As you can see here even in the far side, you can see the investigative work and also forensic. Next slide, Bang. Over the last decade, essentially, we've been in a lot of the major restructuring work in Indonesia. Some of the names here you may find common, and also it's something that you've guys seen over and over, and names may be familiar. We've been covering industries such as manufacturing, a lot of textile recently, airlines, communication, distributor, oil and gas. So yeah, we've been involved in across different range in industry and across this name as we'll go through it. And some of this, the common theme are quite prevalent in a lot of these names. Next slide, Bang. Again, just wanting to touch back, we mentioned that a lot of our work revolves in restructuring, but it also, because of the nature of the work in restructuring, we are getting a lot of exposure in the forensic side, and having Kroll background and having the presence of Kroll in 30 different countries, it actually helped us seeing the cross flow of international trade transactions. And we were able to actually assist in a lot of this restructuring, the forensic work, asset investigation, and then also we are able to get to the bottom of how the fraud was actually perpetrated, especially in a lot of these names where you have complex company structure, and that was mostly done for a reason, right? So having the brand Kroll, it definitely benefit us in being able to see these cross-flow transactions. Next slide, Bang. I mentioned to you the different presence. We're in Jakarta, but obviously we are also in a lot of the key countries and states. Next. I think I'll pass it to Ben just to give you the highlight of what we see and then the key take points here for you to be mindful as we go through the case studies. Over to you, Ben.
Thank you, Wilman. Hello, everyone. So next slide, please, Bumba. So Wilman's explained to you that, primarily we're a restructuring advisor, and the nature of businesses that require restructuring in Indonesia is there's often fraud having been a major driver that causes that restructuring. A lot of the large assignments that we're involved in are effectively collapses of larger fraud that has been perpetuated over a long period of time. There's many different types of fraud, and the sophistication of it varies. But what we've found over a very long period of time now is the key characteristics of most frauds that are undertaken by your everyday business in Indonesia generally have a lot of the same characteristics. One thing that probably surprises many people about fraud is that, there are people who go out with the intent from day one to defraud, but actually a lot of the times fraud is a real slow burn. So it starts with, I've got a banking covenant that I might not be able to meet, so I'm going to manipulate my earnings a little bit. I'll catch it up next year. Next year comes and actually it's bigger and bigger. Then I've got a funding gap, and it sort of snowballs over time. And so that is really what we most often see, things that have got bigger and bigger over a long period of time. So they're a real slow burn. But the very good thing about fraud is the things that we've seen are very easy to identify. And so the purpose of this presentation is to highlight really give you a checklist of the key things that we see, take you through a case study to show you how that exists in real life. I think the other thing about fraud is once businesses collapse with this as a background, the recoveries are very low. So the best thing that you can do is prevent it, not enter it in the first place as an investor, not enter it in the first place as a lender and avoid it. And we think that generally on origination of a deal or something similar, you can identify that, and hopefully we can help you with that tonight. Next slide, Bumba. So a lot of people are always looking at the profit and loss and trying to establish fraud from the profit and loss. And there's two types of fraud. There is manipulation of earnings, and there is asset valuation, so overvaluing an asset to get greater earnings or greater investment, etc. Both, whether the fraud originates in the P&L or the balance sheet, it will always end up in the balance sheet. And so your answer in establishing these is in the balance sheet. So I want you to remember that as we go through this presentation. Next slide. So there's both quantitative and there's quantitative and qualitative warning signs. What we've set out on this page are the three major warning signs, which if you see them together are cause for concern. So the first, and they're easy, right? They're easy to identify. So the first one is Ebitda not converting to cash flow. So in essence, no real operating cash flow. The second phenomenon you see, and it's very easy to identify, is a business will say that it's outperforming the industry from a P&L point of view. But when you look at its balance sheet, it's underperforming the industry, particularly on working capital. So it needs a lot more funding than all of its peers do to achieve that outperformance, I suppose. So typically, just going through one of these one by one. So typically with Ebitda not converting to cash flow, what you usually see there is, now everybody looking at a growing business expects an investment in working capital, right? But what you shouldn't expect is an expansion of working capital days. And usually, if you see Ebitda not converting to operating cash flow over an extended period of time, you will also see working capital days expanding, and that's not a sign of a good business, obviously. and either there's an issue with the business model or that there's an issue with the earnings that have been stated. Outperforming in the industry is easy. So is its revenue growing faster than peers? Is the industry going downwards, but it's going upwards? Very hard to outperform your peers, right? Very hard to beat your peer group in anything in life and in business. So on a margin basis, you've got to have a real competitive advantage to beat your peers' margins, and similar on return on assets or other sort of KPIs. And then we talk about working capital requirements against industry. Pretty simple when you look at the days. How do they sit? Advances is something that always concerns us. The existence of them with a strong business does not really go hand in hand most of the time. And usually, in many cases that we're involved in, you will see working capital values that defy common sense. So a business that's inventory values are double what its storage capacity is, for example. So these are the sorts of indicators to look for on a quantitative basis. And usually you'll see all of these existing at the same time. Next slide to the qualitative, please, Bambang. So qualitative, so warning signs, related parties, limited transparency, aggressive growth in the business. It's not always a good thing to see a business growing if you have some of these other warning signs together. And where is the source of funds coming from? So related parties, what do we mean by that? There's lots of businesses trading with related parties, but really what you're looking for is how is the transactions occurring, and is there a reason for them? Is there a commercial reason for them? Is the structure of the group and how it operates with its related parties, is it really complex? Is there a reason for the complexity, etc.? So opaque structures are obviously set up for a reason. Limited transparency. I don't want to spend too much time going here, but if you have a business, there's no reason any business shouldn't provide its lenders, and to a lesser extent, probably, particularly in public markets, its investors with good information. If you have structures that are set up to avoid that, if you have an unwillingness to provide basic information, that's an obvious concern. Aggressive growth, and we'll talk about it in our case study. High levels of M&A, constant high capital expenditure at the same time as these other warning signs is often companies trying to perpetuate reasons for growth, and our case study is a great example of that. And finally, the source of funds. As you get more and more down the risk curve with your lenders, the existence of mezzanine financing, bonds, in Sharia financing, etc., they're more indicators. Next slide, Bambang. So now we're just going to talk through a case study of a manufacturing group in Indonesia. All of these numbers are real, but we can't identify the industry because we probably identify the case study, and we can't obviously identify this name. So across to Bambang to take you through the case study.
Thanks, Ben. Okay, so to better understand how to identify the warning signs that we discussed in the previous slides, here we'd like to go through a case study from one of our real projects with a private manufacturing group. So the group is one of the Indonesian largest manufacturing groups, and these groups comprise of 6 privately owned entities. And back in 2019, friendly trade creditors filed PKPU petition to this group for all of its 6 entities. And then subsequently, the commercial court entered the group's 6th entity into PKPU, and together owing 21 trillion IDR or $1.5 billion to the secured lenders pursuant to various bilateral and syndicated bank loan facility, as well as the US dollar bonds. Our role here was as a independent financial advisor to a group of 31 secured lenders and we review the group's operations, historical and forecast financial performance, and assist this group of lenders to negotiate on appropriate restructuring terms. And over decades preceding the PKPU, more than 90 banks lent to this group, and at the time of the PKPU, 55 banks held outstanding loans to this group.
That last point there is important. We'll take you through obviously what we think was clearly staring everybody in the face, but over a period of a decade, you've got 90 banks looking at this thing, and at the very end, you've got 55 banks holding the can. When it collapses.
Yep. So in terms of the corporate structure, the group's 6 entities were wholly owned by 2 individual shareholders. And as you can see here, the group structure were not consolidated. And these group structure give the chance for the company to deliberately, put a silo structure to the banks. So the bank's loan were provided to individual entities only, and only few banks held multiple loans to multiple entities. So as the result, the 55 lenders each only receive accounts for one entity and had no visibility of the entire group in terms of the performance of the groups as well.
Incredibly basic structure that they've set up, but it's very deliberate in the way that it's set up to have these 6 entities all owned by the same shareholders. Ordinarily would be consolidated. Ordinarily you'd have lending going up to a whole company or consolidated to the group. But in here, they're very deliberately keeping the entities apart. And Wilman, I think you want to talk about the operating accounts.
Yeah, I was going to say the funny thing on top of that is that none of these lenders actually hold the operation accounts. So the company actually managed to keep the operation account to a completely different bank that is not part of the lending group. And that just adds to the question, right? Why there are so many lenders not having any visibility to the operation account. It was done by design, obviously.
Right. And in terms of the operations, the group claimed that an integration of their business gives them competitive advantage. But the reality, when we have a site visit, the group is actually a collection of 25 standalone factories dispersed across 8 cities. We span over 200 kilometers by road, and therefore, there is a limited collocation of factories, and thus the integration as well.
So one of the things that companies perpetuating schemes like this will do is they'll hold up a shiny, bright toy out to investors, to lenders, as a reason why they're so much better than all their competitors, and as you'll see later, why they can earn better margins. And here, this entity, its tagline on its brand had a word: integration. You go through its capital raisings in public markets, and it talks in one document about its integration 35 times. Now, when you sit back and calmly look at this group, it didn't have any integration.
Well, if you look at the industry trends where the group is operating, it's clear that since 2010, the trade balance for the key products in this industry is negative, and because much more import than the export. And because of this, since 2010, the industry face more competitive landscape from import products, particularly from Chinese producers, and that's lead to a level of price competitions amongst the producer in Indonesia. And later on in the slides, we will see that the group's static growth defies serious issues in this industry. Okay, we have the industry done by import in the previous slides, and now here we look at the group had heavily invested in new factories since 2014, and 11 out of 25 factories has been built since 2015, and they have growing aggressively using the bank loans and bonds to finance this growth. Okay, I think it's probably typical for investors and lenders to look at the financial for the last 2 years in doing due diligence or understand the financial performance and positions of the company. Particularly for our clients here, the lenders will typically review 3 years financial only. And if you look at the financial performance and financial positions of the groups, it looks like both are okay. The sales grew for the last 3 years, and then the EBITDA margins and also the gross margins were relatively stable and decent, and also healthy financial positions.
And of course, you'll remember from the corporate structure that everybody's only seeing a piece of the business, 1/6 of the business. They're not seeing consolidated accounts like what we presented here on the board.
Right. Yeah, but when we look back over 10 years, we could observe that the financial performance of a company has increased substantially since 2010, and the revenue has increased by 4 times, and margins double from 2010 to 2015. And then if we compare the EBITDA, which is the income statement component, to the cash flow, we could observe that only 50% of the cumulative EBITDA had been translated into cash flow from operations. And this is one of the big questions here. What happened to the difference, right? So the difference here it was actually processed into the balance sheet components, which are the account receivables and the inventories. And that's why if you look at the AR and inventory days, the AR days increased substantially in 2010 to 2018, and the inventory days remain high from the same periods. And probably understand that the company or the group could grow the business and require more working capital during the growth periods, but to be able to maintain a good performance or operations of a company during the growth periods, we would expect that a company or a group could maintain their working capital turnover day as well. So it can keep the company or the group efficient while at the same time grow the company. And here with these 2 indicators, I mean, in terms of the conversion from the EBITDA to the adjusted cash flow from operations, and then the expansion of the working capital, it indicates that the group is actually has an operational issue and potentially have conducted fraud or overstated their financial statements.
So, this is very basic, right? And when you look at AR days increasing by 40 days, and you look at inventory days increasing by 50, you sort of say, so what? But at the same time, this group is quadrupling its revenue and it's doubling its margins, right? So, you know, its business is saying that it's performing outrageously well, but having to invest so much into working capital. We'll come back to the working capital a little bit later. What you see on the right-hand side of the screen here, you'll see the purple. That's the actual performance in 2019, established with the benefit of detail, etc. And basically what it appears to us is that historically this business has been doubling its revenue and about quadrupling its margins. And the margin growth had been necessitated to grow as it had to keep perpetuating the scheme. Next slide, Bumble.
Yeah, and if you take a closer look at the cost of goods sold, right, it showed margin movement were inconsistent with the input costs. So the input cost is really determined by the market price and have some relation to the movement in the foreign exchange rates. And also here we also look at that the company had substantially adjust the inventory balance and process it into the cost of goods sold, and this makes the gross margins improve substantially as well from 2000.
Oh, you've just muted yourself.
Oh, sorry. Okay. So particularly for the adjustment of the inventory, which processed into the cost of goods sold, it leads to the gross margin improve from 2010 to 2018. It's improved substantially there. And then, and these adjustments so far were made annually and without clear justifications.
So look, just in a nutshell, they've doubled their margin over 10 years. They've done that in a manner that's totally inconsistent with all the publicly available input prices, which constantly went in the opposite way to what you would expect when they're saying they're increasing the margin. Just on the inventory point, what we haven't shown you on this screen is this isn't just growth in inventory. They had literally written adjustments to the valuation of inventory through of substantial amounts year on year, which add up over time, of course.
Yeah, and if we remember the previous slides where the industry in this company become more competitive and the gross margin, and the company could improve the gross margin consistently over the years, it seems that this is too good to be true, and this is also one of the warning signs that might be an overstatement in the financial performance as well. Okay, you recall that we have talked about the integrations, but here when we look at the related parties, transactions from upstream to midstream and midstream to a downstream, it confirmed that the group lack of integration, and it's even decreased from 2016 to 2018, and these cannot support the margins improvement that we talk about in the previous slides. Then another confirmation that we got here is by compare the gross margin, EBITDA margin, the profitability margin essentially of the group to the peers, the comparable companies, or the average industry peers. It looks like here the EBITDA margin more than double the average industry, and also the operating margins is much better than the average industry. Again, it looks too good to be true for the company to be able to consistently outperform the industry peers.
we don't want to describe the industry for you, but what we can say is it's effectively a commodity business. So there's no real value add compared to all of their competitors. So, that needs to be considered in the context of this. And obviously they've talked about, their integration, which we've shown you both visually on a map, doesn't exist. And then in financials on the previous slide, less than 40%, declining actually year on year, is actually moving through from upstream, midstream, downstream. So there's no actual qualitative reason for the outperformance here. And that in any business, outperforming your peers by that much, in a manufacturing business at any time of a low value add commodity is quite extraordinary.
Okay, for the balance sheet sections, I'll pass these through to Wilman.
Thanks, Bambang. I think just to recap, when we said that when business don't generate cash, those cash needs to be hidden somewhere. In our experience, it tend to be hidden in either working capital or fixed assets. In our case studies here, you can see it's actually both. We've mentioned to you that the industry and the nature of the business itself has been going through a trade deficit in the last 6-7 years. But as you can see here, the company and the group actually keeps growing its fixed asset because it necessitates the additional borrowings and investment in asset, especially in factories and machineries, to hide and to generate those cash and to repay old borrowings. We've mentioned to you the working capital days keeps expanding from 30 days all the way to 70 days and then 145 to 199. And when you're comparing and knowing the product itself, these products, homogeneous products, they don't last more than 5-6 months as it's actually going to go bad. So it does raise question and begs a question in terms of why do you want to have such a high inventory days? So it's something worth keeping an eye out on whenever you're doing your own assessment on any investment, or if you're in a bank on this kind of trend to see why it's growing when the industry is actually in a decline.
So just to re-emphasize, what we're talking about here. So, one of the first slides we went through was that misstatement of earnings always end up in the balance sheet. And if you think about the accounting of that in a very basic terms, if your retained earnings go up, so do your net assets, right? So either you have to increase your assets, which don't really exist, or you decrease your liabilities and they're really higher. So what we're seeing here is the working capital go up because it's the easiest to inflate. And we'll talk about why the fixed assets are easy to inflate. And obviously, we mentioned the inconsistency of their investment compared to the industry.
Next slide, Bambang. Here, we're just comparing it against the comparable companies. You can see here from the AR inventory days, it stood out, right? This group compared to the other companies. Although we do find out that the industry in itself in Indonesia, the peers tend to overstay theirs as well. So in reality, those receivable and inventory should have been a lot lower when you're comparing the industry and other comparable companies.
So this is a real visual representation of what we talked about very early on, which is businesses sort of perpetuating these kinds of fraud will show outperformance on the P&L against their peers and underperformance on the balance sheet against their peers. It's very basic stuff, but unfortunately nobody looks at it in this very simple way. You pull out of the detail and you see it clearly, which we think is represented in those graph lines on the right there.
Next slide. I think I mentioned it to you previously that the group invested in factories it did not need, right? They did so just to get additional borrowings to repay old borrowings. And by doing so, one of the easiest thing that they tend to overstate in our experience are the machineries. because this is such a specialized industry. In our experience, the KJPP, whenever they're doing the valuation, it's very hard to get comparison peer. And then here in this case study, we've found out that compared to what they've listed and published in their financials compared to what the KJPP, there's a significant gap here in terms of overstating the financial, the valuation of the assets. So you can see there at the bottom, the machineries keeps growing and growing. And then the book value, there's still a big significant gap compared to what they've reported. We found out that from our site visit and due diligence, 40% of the factories were actually unutilized. And this is something that when we typically presented this to our typical audience, such as the banks and whatnot, we encourage them, right, whenever you go out and do due diligence, use the common sense, whether or not it's worth having that much utilization. Why do you keep expanding when the utilization is so low? So it's something worth mentioning here.
And in a line, what we were seeing with these with this investment in assets was basically a Ponzi scheme with the underlying assets being factories.
Next slide, Bambang. I think this is one of my more favorite slides. It shows here, you can see from the bottom, the company, the group keeps expanding on their factories from the 2015 onwards, and where they've actually added 11 out of their 25 factories in the last 6 years, whereas the loan and the banking facilities that they've had since day one were never fully amortized. All they've done here, you can see they keep borrowing and refinancing to new lenders, to a new group of lenders. What you've seen here in the gray one, those are the loans that never fully amortized. And then the one highlighted in red, those are essentially the facility that they use to refinance and pay off the old debt. One thing that I do want to mention, and please bear this in mind, typically what we've seen also is that company, when they first started borrowing this, as what Ben said, it's never fully intentional. So whenever they do this, they tend to be borrowing it from the big SOE bank, the big foreign banks. As you can see here, this group borrowed from local SOE banks, and then they refinance it to the syndicate bank or group of foreign banks. But as the fraud keeps getting bigger and the repayment needs to be bigger and bigger, the degradation of lenders' quality here, and then also the size keeps getting bigger. So you can see from SOE to foreign banks to syndicate, then what we tend to see is the inclusion of Sharia bank, and then to a bond, and then potentially to a local regional banks. So you can see the actual change in nature in lenders here. So it's something worth noting that as soon as you start seeing a more commonly seen names of lenders to a regional, and I'm saying anything wrong against it, but it's just worth a red flags and just keeping a note on it.
And
Next slide.
I mean, borrowers wanting to repay early is quite unusual. Right now, they always come for reasons, but it's constant, you know, having a facility for only a year or two when it's a 5-year term and you're paying it out after 1 or 2 years. It's a very unusual activity to see that over and over again. We've just presented one of the entities, of those 6 entities on the screen here. There was another 5, obviously, that looked exactly like this, exactly the same.
Thanks. I think in this, what we're trying to show is that because of the overstated in financials, what we have shown, if you were to take into account the normal working capital days of its comparison peers, what we've done here is adjusted from what the company had previously stated to what the industry standards going to look like. And based on the working capital alone, what we've seen is that there was an overstated off by 10 billion. This does not take into account the revenue, overstated revenue, and fixed asset. As what we've discussed, fixed asset was quite hard to establish, but you can see here, if you take into account those overstated working capital days and other potential earnings and fixed asset, this business never really make any money since day one. Next slide, Bamba. And this is just to highlight the typical covenants, what lenders would typically ask from a company, right? You have your net to debt, the P&L focus, whereas what we would recommend is that add more flavor by adding the cash covenants, because by doing that, you would see a lot more transparency and red flags. As you can see here, if you're just looking at the P&L covenants, everything seems to be hunky-dory, but when you're actually looking at the cash covenants, a lot more alarm bells would actually get to your attention. Next slide.
So just to now recap, I guess, we've gone through the case study. Just next slide, please, Bumble. And we just want to recap for you now. You know, when you heard me talk about those, talk through the checklist and the warning signs at the start, they may not have meant a lot to you. We've gone through things in, I think you'll probably agree, a pretty basic fashion, but the fact is these things are usually sitting there in plain sight, and you actually only need to sit back and look at the basic high-level metrics. So let's go through them one by one. So warning sign, earnings, Ebitda not converting to cash flow. So in terms of the indicators, about 50% of Ebitda over a 10-year period turned to operating cash flow. You know, we saw huge expansion in the working capital days, 40 or 50 days in both receivables and inventory over a long period of time. At the same time, their revenue growth, we didn't mention it in the presentation, but it was about 16.8% over a decade. I think you'll agree most businesses would be very happy with that growth. That is a substantial amount of compounding revenue growth over a decade. But its peers in that same period were low single digits at best. So significant outperformance to its peers in its revenue growth. We took you through the industry, how that looked like. We had a declining industry, not from just 2015, but all the way back from 2008, declining. It really accelerated in 2015, and of course they were investing in those additional factories. The margins, you know, that for us always, you know, hammers these things home. So well above its peers, to a level that just doesn't make any sense in the type of industry that it was in, but also in the absence of any true competitive advantage. We didn't walk through any KPIs against peers here. In a similar case, in a similar industry, you know, we've seen return on assets ballooning over a 10-year period, where another manufacturing business says that its margin is growing from its, you know, new technology, but actually never invested in any technology or any new assets, and the return on assets. It's working capital against the industry. So we showed you, I think it's pretty stark, the graph which shows the accounts receivable and inventory against its peers. Here, the accounts payable days were in line with peers. They didn't appear to be doing anything there. I saw a question in the Q&A about off-balance sheet payables and etc. We often see liabilities also reduced, and that's managed through off-balance sheet financing arrangements. So that's something that wasn't in this case study, but something we see all of the time, and it's certainly a little bit more sophisticated. But if you think about it as what are you seeing in the balance sheet? You're seeing them artificially reduce their accounts payable. And when you do the same basic analysis against its peers, and again, another business in this same industry, it has like 7 days of payables, where its peers are obviously 4 or 5 times that, and that's what it was doing. In this case, we didn't see any advances, but we always do. I would say 75% of the of the cases that have the same characteristics as this have advances. You can often see ways that we're able to establish that the advances are false are they may have saying they've got an advance to another listed IDX business. You go into the IDX other listed business and you see that actually the advances, they don't reconcile or they're not got any. When you really drill into who the parties giving those advances, they'll usually, would sometimes not be legitimate. Working capital values define common sense. Here, they had 6 months of working capital, but actually this inventory was obsolete at 6 months. You couldn't sell it. Anyone with a bit of a background of the business of the industry should have known that and identified many years before it collapsed that there was something not right in their inventory values. Next slide, please, Bumba. Related parties. Hopefully you got a sense of that this business had deliberately structured itself in the way that it traded between the different entities, the way it wasn't consolidated, the way that loans went into those individual entities, the way there was no transparency across the parties. And if you all boil it down to it, it's just number 3. It doesn't make a lot of sense. Number 2 and number 3, sorry. So, they're in the same industry, but not included in the same borrowing structure. It should have been a consolidated business. Limited transparency. So, many of you are not bankers, obviously, but, when we're working with lenders, and Wilma talked about it, here there was 55 lenders. 55 lenders, that's a lot of banks. And not one of them held the operating account, which is obviously a key thing that banks are trying to sell, because obviously you've got higher deposits, etc. So, that is something we see a lot these days. And if you see any business that you're involved in that is doing that, it doesn't make a lot of sense. It's actually a lot more complicated when you're trying to trade. It's more simple to have less lenders, less counterparties, etc. So, here, number 2 in limited transparency, all of the lease lenders were getting was accounts, audited financial statements and the debt service accounts. So, a point to make is, lenders always just check BI register, etc. And usually they'll find that there's been no payment defaults, etc. So as long as that continues, they're happy. We didn't talk a lot about auditors, but here it was not a big name, and the auditor was there for a long time. Which is the last point on limited transparency. But, unfortunately, globally and Indonesia, these things get past auditors too. They get past the Big 4. You could list many names globally in Indonesia where that's happened too. So you can't just rely on audited financial statements. This sort of checklist hopefully will help. KJPP valuations, some of the regulations around KJPP are very difficult for valuers to operate within. And I think you'll find they really limit the amount of information that's provided to support that valuation. And unfortunately, investors and banks rely on that, and sometimes there's bad actors. And here, I think it's, we were able to establish that the machinery had been significantly overvalued. Aggressive growth, we talked through that. Really, they bought 11 of their factories in a period where the industry went backwards, and they did so because they were able to, through the valuation process, overvalue machinery that nobody could understand. So none of us on this call, I'm sure, are able to value specific machinery for a very specific industry without doing a lot of work. So if you're an investor or a banker, you're going to rely on others, and that's what happened here. And unfortunately, that was lent. The security was machinery, and actually, it was worth much less than what they stated in book value and what was in the valuations. Next slide. And source of funds, really important. One of the more recent slides we talked through, where you just saw them going across the page, weren't repaying anybody, just refinancing because they had no operating cash flow. So you just new borrowings to pay old borrowings, and refinancing early and often is always a major warning sign. We certainly saw that here. 55 lenders, I think, meets the criteria of many lenders lending for the same purpose. You had, a really wide range of loans that were in this particular one, and Wilman talked us through. We got across and through much more riskier or lenders with probably not as great governance as what large local and foreign banks would have. Over to you, Wilman, to talk through the balance of the presentation.
Thanks, Ben. I think we just want to highlight here to you guys the fact that not only in manufacturing that we have seen the overstatement and hidden of earnings into working capital assets and balance sheet, right? We've seen it in distributor businesses, oil refinery, multi-finance, trading company, and the common theme that we have seen over and again is the overstatement of earnings and then hidden in working capital assets. You can see in the 4 or 5, all of these guys, they show the same common thing. Maybe one it's worth mentioning in a multi-finance, for example. I think because this is quite a recent public name, I think we can share this. We were talking here on the Sun Prima, for example. The Sun Prima, they ended up the company resorting to actually falsifying receivable because they have to keep up with the working capital assets. So that's something that, for example, we have seen time and again, not only in Indonesia, but across globally. Next slide, Bambang. I think just to recap, guys, we have talked and gone through the case study. Just to bear in mind, this is worthwhile mentioning. Prevention is better than what we have seen here, which is a cure. For example, the warning sign, do it early, pick it up at the original level, origination stage, and I think you will have a much better chance of success, either not getting into it or at least structuring a viable security to protect your downside. Because when you're actually getting involved, and this is where we tend to be involved, is at the restructuring stage, there is minimal or there's nothing, not much that you can do to secure or at least get back your investment on the company. If you have the viability and visibility of getting financials longer than 3 years, we encourage you to do so. By the client refusing to cooperate or even share with you this information, it could also be acting as a telltale sign whether or not they have something to hide or they're literally transparent. It's worth noting that if you can definitely try to get a longer period of information. Ben mentioned that in the BI checking, you don't get to see what the company, whether or not they have actually been repaying their old debt. All you get is actually whether or not the company defaulted on it, but you don't actually get that refinancing pattern or trend. So it's definitely something worth noting. The third point, focus on cash, because that's what gonna get, cash is the one that's gonna pay you your interest or pay your dividends or pay your investment on the company, right? The earnings is easily manipulated as what we have shown to you, but it's very hard to fake cash. And that's where having the bank account, for example, having visibility to the bank account, it's very important for you as well. Test the performance against peers. It's very hard to be leading, let alone industry standard. So sometimes when it's good to be true, you need to bear in mind, is it worthwhile? Have they done something so different compared to the peers to warrant such performance? Next one, and this is something that I'm sure you guys have also seen, complex lending and company structure designed to obscure the lenders from not having full visibility on the business on its own. some by design, some maybe just the way it is, but we've seen that if it's too complex, maybe it's worth raising the question why it was designed for so. Because what we have seen, for example, I don't know if Ben wants to mention, but in airlines, what we've seen in airlines, because the complex structure and the nature of the lending, sometimes, for example, when it comes to securing the rights of the lessor, it becomes very, very, very difficult. Ownership trading structures, we've mentioned that. And then also what we mentioned, appointment of reputable auditors and KJPP valuers. In this case, it wasn't a reputable one, but we've also seen brand names. So when you have seen the same auditors and the same KJPP valuers across a number of years, it's worth mentioning and raising it as a potential red flag. And the last one, I think the sooner you can get your foot on the door and raise these issues, the sooner you can actually have a potential better recoveries. So have that discussion, have a discussion with the company as often as you can. So I think those are the key telltale signs and preventive steps that what we have seen works best. And I think it's if we can share anything, then probably this is it.
What I might just say to finish up for all of you who are here, if share it, we can't share this case study with you separately, but if any of you would like to see, receive the checklist from us, we'd be very happy to provide that, and please do reach out. The other thing to finish up on is we've seen a lot of this in the last 2 years in particular. I think fraud, it's able to be quite easily perpetuated in growth, economic growth. And when the conditions for being able to say that you're growing, like this business and other businesses in its industry have been able to get taken away, suddenly it sort of spectacularly collapses. You've seen that globally, as a result of COVID and obviously the changing economic conditions where people can't continue. So for you as investors, as lenders, as business managers, as advisors, we're still in the period where these things will fall. It has been going on for 18 months where the conditions have been as they are, but you've also had more flexible situation where bankers have still been very easy on payment obligations, etc. Eventually that'll stop, and you're going to continue to see cases like we just set out for you today. So I'd suggest being pretty vigilant for those who this is applicable for. Should we take some questions? I think there's a few in the chat.
Yep.
Thank you, Ben, Wilman, and Bambang for the presentation. And before we continue to the Q&A, I would like to remind everyone that the next event for the CFA Society in Indonesia is the Women Empowerment, Propel Your Career Through International Certifications. Our next webinar lecturers are all CFA chapter holders and are all female, and it will be held on August 26th. So if you guys haven't signed up, please do sign up as soon as you can. And with that being said, we're going to continue with the Q&A. We have a few questions on the chat box. I'll start with the first one from Hega Charisma. So Hega's question is it possible with a company with many business units to do off-balance sheet payable transaction or manipulate its debt position?
Yeah, I saw that in the chat as we were speaking, and I addressed it very quickly. It's very possible and very common. So in the case study we talked about tonight, they inflated their assets, but the other way, if you're trying to show increased retained earnings somewhere, it has to be higher net assets. So you have to increase your assets or decrease your liabilities. So we very often will see that. And that is, as I mentioned when I was speaking, a little bit more sophisticated. But when you look at financial statements of the company that you're involved in, it will show the same thing. So it will show lower payables compared to its peers, and that will be unusual. So in that situation, you probably have the inflated receivables and inventory, and you also have, for some reason, they're paying their suppliers quicker. And really what's happening is they're taking it off balance sheet to pay. Hope that answers the question.
Okay, thanks, Ben, for tackling that question. Our next question is coming from Jasmine. So on the covenant imposed, I'd say adding minimum credit throughput in the bank or main lender would help. But hearing from this case, it may be hard as there were too many banks or lenders involved.
Yeah, look, it's a statement which I agree with. I think the only thing I'd say to that is, what I mentioned when I was going through the checklist. From a lender's point of view, and from the lender's point of view, if they go and do their BI check and the borrower, the company is always paid, they get very, that's a internal sort of credit. That's a good thing, right? But it's obviously in the context here, eventually these things collapse. The other thing you'll see is, these things can often be perpetuated by very large companies. I mean, we've seen billions of dollars of this stuff, and that high value tends to attract lenders. It tends to attract investors, and usually these things have a nice story around them. And we pulled the story of this one apart a little bit. There's different stories for different businesses. So I would agree absolutely with that. I just think lenders find it difficult to restrain themselves sometimes because their job is to lend money, right? What we're trying to do here is help investors invest to miss these things and help lenders avoid lending to these situations.
I bet, especially with a lot of banks involved in the loan.
It's a very good point. The other thing I would say there is, comfort in numbers, and we often see, oh well, look at all these banks. They must have looked at this company. It must be fine. They must have done lots of work. So we'll just piggyback on that. And you see situations where you might have a very reputable, lead arranging bank in a syndicate. So everybody just says, well, that lead arranger must have done some work. But of course, the incentive is they're being financed, and the level of work they do may not be sufficient, or they may not look at the right things.
Yep. Right. Thanks, Ben. Our next question is coming from Steve. Why can the auditor not find any fraud or abnormality of company financial statements during the audit process, despite having better access and information than lender or investor? I think Ben. I don't think he looked. I don't think he looked. Unfortunately, we've had very interesting interviews with auditors when we come in with hindsight and look at these things. And I'd say the general themes are that they've either worked with the company for some sort of benefit, or they haven't done the work. The other one that I would say is they're often very complex and large, and you have, it's very hard to understand some of these things. And I think auditors are very cleverly manipulated, maybe is possibly the word, by saying, sorry, we don't have this information, but we do have this little piece, which is fine. Sorry, we can't do this in time, but we can give you this. So I think a lot of that goes on as well. Sure. Our next question is coming from Jasmine. Was there any consequences received as a punishment or sanction by the KGPP or auditor on this case?
No, and unfortunately there never is, right? There's a couple of reasons for that, but the major reason is, there's a major money at stake If you want to chase an auditor or a KGPP and spend the money to go through litigation, that obviously takes a long time. In Indonesia, the outcome's uncertain, and it's got to be funded. And so I think, people who have lost a lot of money in these things don't tend to want to chase that unless there's something at the end of it. And usually the fact is that, what that party may be able to pay us compensation isn't going to help their recoveries, and they're better off moving on, unfortunately. We think, if you, for those of you who are familiar with, the Enron case, for example, which led to the collapse of Arthur Andersen, consequences for these parties is the answer to preventing these things generally in the future. But our attention when we're undertaking these roles is we focus on the shareholders and the management.
Okay. Thanks, Ben. In regards to this case study, so who should the auditor report to if they find such these conditions?
They should report in their audit report, right? So look, it depends on the question. If you're talking about the signing partner for an audit report, well, they should not pass the audit for number one. That will bring things to a stop because that has implications for public companies. It has implications for private companies. That has implications for lenders who can't continue to lend. So auditors finding these things and doing the right things is what will find these early, and because they and the valuers in particular are the parties being relied upon by investors and by lenders to do their job. So if it's a junior auditor, it's obviously a more difficult question, and then you're trying to deal with the issues that may be going on in that firm or with that particular partner that's led to the situation in the first place. And that's been much more complicated, and you could probably go through an entire presentation on that separately.
Our next question is, when can we conclude this problem couldn't be solved anymore?
I'm not sure I fully understand the question.
I guess for Pak Fandi, maybe you can elaborate more on the questions so we can address it later on. I think we can go to the next one from Pascal Panutun. Shall we consider the payable when evaluating the overall leverage, especially recently when many approach of stretching the payable to suppliers?
Yeah, look, you should. There's formal and informal ways of doing that. But I think, what someone's stretching payables now, they need to, repay later. And the nature of businesses is, while they are unsecured creditors and a lender, I assume this is from a lender, this sort of question, and a lender is secured, you have to pay your suppliers, otherwise they will go through a bankruptcy process, etc. They won't trade with you if they're important. So, we don't, in these situations, we don't often see, believe it or not, high payables all the time. We do, in these fraud situations, in business model or industry issues that we're involved in restructuring, we obviously see that all the time. But I think if you're an investor, you need to think about the fact that you're not getting dividends later because they're deferring the payment, and if you're a lender, it's going to make it harder to repay, obviously. So, personally, the way I look at that is, what is the normal level of payables? So if it's 45 days, that's normal for the industry, that's been normal for this business, but it's now at 90. Then the way that I would see the additional leverage that's in the business is that additional 45 days in payables.
And then our next question is, why did corporate choose Sharia lender as financing optional?
Oh, look, there's lots of reasons for that. You know, that are very, very genuine, right? We don't, you know, what we see, I suppose, is that, you know, some institutions, including some Sharia institutions, and we're not talking about, you know, a lot of the well-established institutions, they just have less governance sometimes in their review of lending, right? Just like a local regional bank has typically, not always, but typically less than a large, you know, than a BCA, for example, you know, or a HSBC as a foreign lender, for example. You know, there's just different levels of scrutiny being put on those companies, and they, you know, as we see them move across that, you know, we see higher risks. Bonds is usually a bigger concern for us sometimes. You know, sometimes it's very sensible for bonds, but sometimes when you're seeing crazy bond packages, you know, the market's getting a bit out of, you know, not quite at the level that it should be. So if you're seeing low yielding unsecured bonds, as was actually in this case study, that's when you know they've really stretched it. So actually, you know, we didn't point it out in the case study, but it was only a handful of months prior to the collapse of this business. You know, they issued a very low yield bond, US dollar bond, which was entirely unsecured. And that's just when they stretched to the level of, well, those investors have a high level of risk appetite. They're offshore. They're relying on a lot of intermediaries to do their work for them, and they're really playing the macro market rather than the individual, you know, exposure in many situations. And so that's what we mean by going down the credit. And so, yeah, not particularly about Sharia lenders.
I think, Ben, just to add, in this case study, I think the group has gone through run of the mill in terms of all the lenders they've gone through from the common names. They could be financing it, and eventually they need to find a new banks they'll be willing to provide new funding for their activities, right? And then also in Indonesia recently, we've seen a lot more, maybe not bonds, but MTNs. In the case study we've shared with you, those are one of the larger transactions, the 500 million and above, but we have seen it time and again in the smaller transactions, 100 million less, medium-term notes being issued, unsecured, exactly the same nature, where they've gone through the banks and then now they've gone through the more riskier financing and higher costs, obviously.
Okay, thanks, Ben and Wilman. I guess going back to the valuation for a fixed asset, how do they inflate the value of machinery, given that the invoices for these machineries are set by the maximum book value of the machinery?
You want to take this, Wilman?
Yeah, I think this one, we spent a lot of time trying to assess in terms of comparison. When we did our site visit and due diligence work, we found that a lot of the machines, for example, were secondhand. So a lot of this machine, if you want to put in the effort, you can actually go to Alibaba and then find a comparison. But in this case, and also other case studies that we have seen, the company can use a third party, a friendly third party, to acquire these machines initially from, and they can inflate those acquisition price, right? And that's where a lot of these foreign subsidiaries or foreign intercompany, they can be acting as a provider of this machine. And we've seen it in this case, actually, they bought it from a friendly party at an inflated price compared to what you would typically see from the secondary market.
Thanks, Wilman. Our next question is, I guess, how to find out the existence of red flags receivable aging data?
I think, so in terms of any one of these issues alone is not any reason for major concern, right? So, you know, receivables existing that is higher compared to the industry on its own, it's not a major worry. But when you see, all of those warning signs together, or a high number of those together, that's when you need to be concerned. So that's what we certainly tried to set out in the case study today. But I think it's about two things: what have they done historically, and what do their peers do? I think that's as simple as we could say around that particular issue for receivables. So, is it normal for them to be 45? Is it normal for them to be 90? And is it normal? What is the industry running at? And if there's a discrepancy there, there's something either, generally it means it's a business model issue most of the time. I would say 9 times out of 10, it's a business model issue.
Thanks, Ben. Our next question is, given your experience and background, is there any evidence that fraud and manipulation practices happen much more often in private companies rather than public ones?
Man, I'm afraid so.
That's a very good question, though. I mean, I think there's more in private than there is public. But to be honest with you, we could see a number out sitting in plain sight, right? That are listed. Some of the things that we've been involved in have been listed. But it's obviously easier to do this in a private situation. The case study that you saw today, I saw people trying to guess who this business was, but the case study that you saw was private. It wasn't a publicly listed company.
Right. Thanks, Ben. And I guess this is our last one for today. Instead of operating cash flow, our free cash flow also give good indication for the fraudulent actions?
Yeah, that's a great question. I mean, we simplify it to operating activities, and we talk about capital expenditure separately. I mean, free cash flow is another word for it. I know Warren Buffett talks about owners' earnings, and really that's obviously looking at businesses that have a lot of CapEx. So it really depends on the business. This particular business, its machinery lasted quite a long time. And so most of its capital expenditure was investments in new machinery. So that's why we separated as operating cash flow rather than free cash flow. If you had a business that, I'm trying to think of a good example off the top of my head, but if you had a business that constantly has to invest in capital expenditure to continue to earn its sales, then you should be looking at free cash flow, or owner's equity or owner's earnings. Sorry. So yes, both are fine.
I think
just to finish off, with Ebitda and operating cash flow are proxies for each other, right? So that's why we don't focus on free cash flow. What you should hope to see is as much as possible. You should hope to see, with the exception of maybe some interest in tax, you should have those equating to each other at a high percentage.
Okay.
So I think it's, just to add a bit of explanation on what Ben has explained so far. I think, free cash flow probably can be one of the alternatives to the operating cash flow. Just make sure that the components that we are comparing are consistent one to another. So for example, if we want to compare with EBITDA, make sure that you use the free cash flow to the firm instead of free cash flow to equity, because the EBITDA is essentially the profitability available for the shareholders and then the lenders. And while to be consistent, it should be free cash flow to the firm. And here in our case, we use operating cash flow, which actually an adjusted operating cash flow, which already added back the interest and also the tax, so it's also comparable to the EBITDA. So it's supplementary to one another, I think.
Thanks, Ben and Bambang. I guess we have one last question. Are there supposed to be annual impairment tests for machinery that prevent this trick going so long.
Yeah, I mean, that just comes back to the auditor, right? Not doing their job. The auditor should obviously be testing that acquisition of the machinery, on a sample basis, obviously. And they should be doing the annual impairment testing, but they're not. And that's what it gets back to. The major breakdown here is those independent third parties who are supposed to do the checks and balances aren't. And everybody, the investors, the lenders are relying upon them, and that's where these things are able to go on. So.
Okay, thanks, Ben. I think that's all the questions that we have from the chat box. So if you guys don't have any other questions, so thank you, Kroll Indonesia. Thank you, Ben. Thank you, Wilman, and thank you, Bambang, for your time, for setting up this webinar for us. And I hope we can work together again sometime in the future. And so for just a quick reminder, our next event is on the 26th. So hopefully you guys can sign up for the event also. And thank you guys for the webinar. And I hope you guys enjoy it. Good night, everyone.
Thanks, everyone.
Thank you, guys. Thank you.
Thanks, everyone.
Thank you, everyone.
Thank you, everyone.